Welcome back to the Global Ledger. I'm Justin. Today we're stepping into the center of global finance, the market that anchors interest rates, pricing, collateral, and liquidity, really for the entire world. Every clearinghouse, every dealer, every central bank, shadow bank, fund manager, pension, so on and so forth, all of them reference this one market. This is the place where the global hierarchy becomes real, the place where the financial system decides what safe really means, the place that underpins your mortgage rate, corporate credit spreads, global valuation models, and dollar funding itself. This is the U.S. Treasury market, and I like to call it the world's balance sheet. Let's get into it. The U.S. Treasury market is over $26 trillion in size. But the number doesn't matter as much as the role it plays. Treasuries aren't just debt instruments. They are money-like assets at the top of the global collateral hierarchy. They serve three critical purposes. Number one, store of value. There is near universal confidence in repayment. Number two, collateral. Treasuries are the best collateral in repo markets, clearinghouses, and derivative margining. Number three, it's a benchmark. Every other interest rate in the world is priced as a spread above Treasuries. So it really is the world's balance sheet. Every institution, from a small bank to a global sovereign fund, manages its risk, valuations, and liquidity relative to Treasuries. So there are two kinds of money. Money you pay with and money you fund with. And Treasuries are the second kind. They're really the primary asset used to borrow in repo to meet margin requirements and to secure short-term funding. So when you hold Treasuries, you're holding liquidity, you're holding safety, you're holding funding capacity. They are universally accepted, and they rarely lose value quickly. And they can be converted into cash instantly through repo. That's why they sit just below reserves in the hierarchy of money. So the Treasury market is not simply government issues debt, investors buy it kind of thing. It's a dealer market, meaning primary dealers make markets by quoting bid-ask spreads. They inventory Treasuries. They fund that inventory in repo. They hedge using futures, swaps, and options. Treasury trading relies on balance sheet, leverage, liquidity, collateral, speed, risk management. Dealers must constantly take the other side of institutional flows. So foreign central bank selling reserves, hedge funds putting on basis trades, pensions rebalancing, corporate treasurers raising cash, the U.S. Treasury issuing billions per week. If dealer capacity tightens, Treasury liquidity vanishes. So this happened in March of 2020 when the Treasury market broke and spreads exploded. Well, until the Fed intervened. So I'm referencing the document. Again, I've mentioned in this episode, it's a great document. It's a long document, but go through it slowly. But as it pertains to the Treasury market, there's something in there I'd like to talk about. And I've mentioned this before. The Federal Reserve's responsibilities include promoting financial system stability and fostering payment and settlement system efficiency. Treasury market stability is both. Because Treasuries are the safest global asset, the core funding collateral, and the benchmark for all other interest rates, the Fed must ensure that dealers have the balance sheet capacity and settlement tools needed to keep the Treasury market functioning. This is why the Fed acts through primary dealers, manages the repo market, intervenes during crises, provides securities, provides security lending facilities, and backstops the system as the dealer of last resort. When the Treasury market wobbles, everything wobbles. Interest rates, discount rates, mortgages, corporate finance, global credit, so on. And that is why the Fed will always step in. So, why is it that Treasury liquidity shapes every market? And that's because Treasuries drive global valuation because they anchor the risk-free rate. Every DCF model begins with the Treasury rate. Credit spreads. Corporate bonds are priced as a spread to Treasuries. What else? Repo funding costs. Treasuries determine the cheapest form of collateralized borrowing. Swap rates and derivatives. The entire fixed income derivative universe references Treasuries. What else? Equity valuation. The cost of capital uses Treasury yields as the foundation of discount rates. And maybe lastly, FX market structure. Dollar strength is partially driven by global demand for Treasury collateral. So when Treasury liquidity dries up, discount rates will jump, valuations fall, things get a little rocky. Cross-asset correlations go to 1. Global credit freezes. So Treasuries are the transmission mechanism of global financial conditions. So we've seen it before. 2014 flash rally. Liquidity vanished, yields plummeted, and regulators realized market microstructure had changed permanently. 2019 repo crisis. Treasury financing failed. Repo spiked to nearly 10%. The Fed intervened. In March 2020, Treasury market collapse. Mass liquidation from global funds overwhelmed dealer balance sheets. Bid-ask spreads blew out. Market depth evaporated. Treasuries, the safest asset, became temporarily untradeable. So the Fed responded with QE, massive repo operations, the FEMA repo facility, and direct support to primary dealers. Treasuries had to be saved because Treasuries are the system. Let's anchor valuation in here for a second. So every valuation formula from DCF to bond math starts with a discount rate. And every discount factor is ultimately anchored to Treasury yields, Treasury liquidity, supply and demand, Treasury repo rates, and the functioning of the dealer system. So when Treasury volatility rises, discount rates become unstable, equity valuations fall, credit spreads widen, hedging becomes more expensive, funding costs rise. This is why the risk-free rate is the most important number in finance, and why the risk-free rate is a function of dealer balance sheets and collateral markets. So these two ideas merge in the Treasury market. And understanding the Treasury market in the mechanics starts to you can start to make sense of the Fed's actions. Quantitative easing, repo dynamics, market stress, and valuation. And treasuries are not just government IOUs. They are the global economy's benchmark, collateral base, liquidity anchor, and discount rate engine. So understanding this clarity gives clarity, I should say, that most investors never reach. So thanks for listening to episode 30 of The Global Ledger. We explored the true foundation of global finance, and that was the U.S. Treasury market and why it functions as the world's balance sheet. in episode 31, we're going to begin a new arc. And we're going to talk about the anatomy of a liquidity crisis, where we take everything we've learned so far and apply it to the moments when the system breaks. So once again, I'm Justin, and thanks for being here.